Good morning to everyone. I hope you're all fine on this fine Saturday morning and ready to take a course of today with me. I welcome you all to yet another session of financial reporting. Today, we are making a formal start of the course of today because the last week we have met, we have had an introduction of everything. A lot of information that I had to share, and you people got an information of. Lots of other things the last session we have spent on. But without any further delay and with the waste of time, we have to get into the start of the course today. So let me connect to the board so that we can start not just the lecture of today, but also the course of FR. All of the planning the last week had shared to all of you which chapter we will be starting and why. We're not getting into that debate, just straight away getting into chapter 5 in front of all of you on tangible non-current assets. The face of this chapter shows that we have got 4 reporting standards to work on, and all of these 4 reporting standards are connected to each. So they have been categorized in the one same chapter. Alongside, I have been able to open the whiteboard explanation on which I will be explaining the whole of the topic. And then we have got the summary, which I will be using also. So today you will get the whole taste of the way the course is conducted, the topic is delivered, to what extent do we use the lecture notes, to what extent do we use the summaries, and what do we do on whiteboard. And then in the end, if the topic is finished, and the time of today will allow, we will take ourselves into practice kit also to practice, which I don't believe we will find the time because we are starting off with the topic that will take the whole course of today. If anyone has joined me in between the last Saturday session, you were not. I hope by this time have already watched our introductory course from the recording provided. And if you have not, take a time out this weekend itself to watch, because there are a lot of useful things I had talked about, which you as a student of financial reporting needs to be aware of. Okay. This is the summary of property, plant and equipment, IAS 16. And if I look onto the face of this chapter that has 4 reporting standards, we will be focusing today on this topic only, which will be a revision to most of us, because they have done this property, plant and equipment previously. The topics like depreciation, disposal of assets, revaluations, and all the related accounting. But the next 3 topics, as you can see, are totally newer. Never in the life you previously have studied. Maybe for the very first time you have heard of borrowing cost, grants, investment property. But yes, this topic you are associated with, and we are starting the course from that one first. So forget about the next 3, concentrate only on I-16. And let me tell you, although this I-16, a topic is being marked as a revision, but still, we will be learning this topic from scratch. I will be assuming that never in the life you people have done this topic before, and you also at your side will even be thinking of that, okay, I'm going to learn something new and never in the life previously I have studied this. This will make you concentrate a lot more. It has two reasons why this whole topic of property, plant, and equipment needs to be formally talk about. Why? Because first reason, the way this topic is going to be examined at this level will be totally different from the way it was previously examined. So I cannot trust the knowledge that you have gained previously, since by keeping that knowledge, you cannot apply it to practice and face the exam questions on I-16 of this level. So I cannot trust that. And even most of you come into FR course, they forget about what they have done at level 1. So this topic needs to be taken seriously. I will surely, this applies to you also. Second reason, this I-16 is the entry point to this course. Many next standards, which we are planning to work in all those weeks to come, not just in this chapter, even chapter 6, 7, 8, and many next, based onto this. It's a foundation. And you start constructing the building from foundation, not from the upper story first. And you cannot bypass the ground floor or the foundation. You need to have the staircase to go up to the first, second, third, fourth story. Whatever we will work is going to impact for long. Many of those next topics are going to be based upon the discussion of the course of today. So if this has not been good, you will suffer. For all those lectures to come, for all those standards to come, those are based onto this. It's like a tunnel that has an entry point, an exit point. And you cannot enter into a tunnel midway. You know what I'm talking about? You only have that one entry point. An entry point is IAS 16, that one cannot just miss it out. Has to enter into that tunnel from that point. So by many ways, I have been able to try to make you realize so that you at your side sit so attentively and patiently. Because there are some of those areas which, when will come into discussion, you will feel like, oh, I know this thing from the previous course. And this might make you feel a little casual about, okay, I know this depreciation thing. So if the lecturer is explaining to me, I already know this thing, that thing, and this thing. That's what I'm telling you. But there are plenty more areas, those they require to have your full attention because they are new areas. So to end this debate, the whole course of today will be on I-16. And I need to have your full attention for all of those reasons. I already have told you that why is it so? It's not just the topic of this course. It's going to have an impact in all those next topics to come. And I'm not saying this. You will feel it. Let this course to go forward to the next week, third week, fourth week. This will be proved. And then I will ask you if I was right or not. You will see it that the topic of today will keep coming to our way in all those next topics to come. You will feel it by yourself. I can bet you on that. Let's start with the topic of property, plant, and equipment. Let's keep the summary in front. And then we will be able to make the use of these lecture notes. You will see the way we will. Starting off by the definition of property, plant, and equipment. This is I-16. property, plant, and equipment. Let's not learn the bookish definition of this topic. Let's try to learn the way the whole thing becomes easier. Because you will not be asked to reproduce the definition, so that you need to have a very nice definition and to make an impression. So you should cram it word by word. Useless. Being an accounting professional, you should need to be okay with the accents, but not cramming the one line or two lines will make anything good for you, even for your professional life or your exam, because you will never be asked to reproduce the definition and get marks. I have tried to divide the whole definition into many parts. There are 4 parts, and I can first of all label those 4 parts. This is the first part of it. This is the second part of it. That is a third part, and this one is the fourth one. Let's go to look into each part one by one, and then in together, we will take them as whole. So it starts out by the word non-current. Then it takes the word tangible into it, asset into it, and then use. An asset that provides the benefit for more than a year is called as non-current. Any asset, the benefit of that you get is more than 1 year is called as non-current. And in such nice manner, to the point, it's there. No such text you will find, rather just a word or two. The dictionary meaning of the word tangible is can be seen, can be touched, can be felt, does carry a physical substance. Anything that cannot be touched, anything that cannot be seen is rather called as intangible, lacks the physical substance, but this will have a physical substance. Can be seen, can be touched, can be felt. So anything that can be seen, that can be touched, that can be felt is called as tangible. Fine. A definition of asset is very important for us to understand. Generally, we all know what is asset. But formally, if you have to learn from the conceptual framework, it defines the asset this way: a resource controlled by an entity from which the future economic benefits are expected to flow towards enterprise. Enterprise means entity, company, business. This word has got a lot of importance. Controlled by entity. What does that word means, control? Controlled by entity means what? If anything that is not controlled by you, you cannot guarantee the benefits from it in future. I gave you a few examples from the life that we live in, so that you can associate yourself to. Or if I try and give you an example of my setup that I'm running to conduct all of these courses and all the setup that I have, the assets I have. Taking the example of, okay, the laptop, the system that I'm working on, a lot of things, by the way, that I can associate myself to, that is around into my workplace. Taking an example of laptop. This laptop is tangible because it can be seen, it can be touched, does carry a physical substance. It provides me the benefit for more than a year. Had been providing me the benefit, will even be. It does have a life of 5 to 10 years. As long as I do not change it myself after 6 months or 1 year or 2, But it can run for around 4 to 5 years, even more than that. Non-current asset. This laptop is controlled by me. The word control means this laptop is always in my custody. I always keep it along with me wherever I go, in my bag. I come to my workplace, it's with me. Then it's password protected. I enter into that laptop to do whatever I can, and then I shut it down. So what the few of those examples that I have told you clearly suggest that this laptop is fully being in control of me. No one can access this laptop without my permission unless or until someone steals it away. It's not in the use by anyone around except me. Not even my wife uses it. Not my children, even they use it. It's solely in the control of me and my business. So by having a physical possession over to it, I have a full control over to it. It had been providing the benefits to me for all those past years. It is providing me all those benefits and it will keep on. So I will be calling this laptop to be the property, plant, and equipment of my setup, because all of the parts of the definition are satisfied on it. Non-current it is, tangible it is. I have a full control over to it by having a possession, and this makes me give those benefits out of it. And ultimately, why this laptop has been held for? Is it for sale? No, it is for use. It's in my use. It has been kept in my business to provide me with the benefit of service. By getting the use of this laptop, I am generating the benefits, conducting the courses. So when all the 4 parts of the definition are being satisfied on it like a checklist, surely a property, plant, and equipment to my business. Many examples I can give it to you. Many examples. And you think of an example, those are around you. Taking an example of a motor car. Tangible, because motor car can be seen, can be touched, can be felt, does have a physical substance. The benefit of motor car, if not for 10 years, at least 7 to 8 years, non-current. Controlled by me. I only have a key of that motor car and I open it and I drive wherever I would wish to. No one is allowed to except me. By having a control over to it, I'm getting the benefits out of it. It's me who gets the benefit out of that, no one else. And why that motor car has been kept for? To sell it to someone tomorrow? Is it being displayed in showroom? No, it's in my use. I'm getting the benefit of service out of it by driving, by going to the places and meeting the clients, or even while delivering the goods and services to customers. It's in my use. Or even it provides a pick and drop service to my staff. So motor car can be used for many reasons: delivering goods, pick and drop service. Meets the definition of property, plant, and equipment. So the better way to understand the definition is to take any example that's around you and try to pass it through to these 4 parts. And if all the 4 parts are ticked, it's property, plant, and equipment. Emphasize on this word control. Then the uses can be of many, like machine is held for what sort of use? Production. But depending upon the nature of, I cannot be using this laptop for production. The laptop is for administrative task. But machine is meant for production. Motor car is meant for delivering goods or providing pick and drop service to staff. Factory is a building, will be used to have factory building, office building, administrative hall, accounts office, retail premises. That's the buildings are used for. And fixtures like tables, chairs, lightings, air cons are all used for administrative purposes. So each type of asset may have its own use, but bottom line is that I'm having all of those assets in my business, not with the intention of selling them tomorrow, with the intention of using them. All the tables and the chairs, the microphone, the fans, the aircon, my electric appliances like microwave, like refrigerator, and all that stuff that is in my workplace, they are held in my business to provide me with the benefit of service. I have a full control over to them, first of all, by becoming an owner of these things. And secondly, it's always locked into my workplace. When I come in, I get the benefit out of this. All of that stuff, no one else will have an access to it. Tangible they are, non-current they are. All of them are to be the property, plant, and equipment of my business. That is how the way at this level you will have to understand things. And at the end of the day, you will find it so easy to revise because the essence has been understood. Not just the definition was read for about 10 odd times and you possibly have crammed it only. Okay with that? Any example that is around you, or if the business that you run, or you do not run a business, but you work for a company, which is at itself a business of someone. So you try to look into that business. Okay, this business has all of these assets. So are they tangible? Are they non-current? What sort of use the company makes out of them? Are they being controlled by that business? See, you work for a company and you're provided there with a system, a laptop or a computer. You can simply see that that laptop is being controlled by that company. And you're not allowed to use that laptop for any other sort of activities. And you're not allowed to take it along. Or you can start using it for your family. Because that's not for you, that's being controlled by a company. All the things, those are there, the printers, the stationery items, the fixtures like tables, like chairs, it's all being controlled by that company. And they are the one getting the benefits out by using them. And you as an employee, a staff member, cannot even use them the way that you would want to be, as you not the one. So try to understand this by definition by taking a lot of examples around those are around you and then pass them through to this one, second, third, fourth part. You'll be so comfortable in learning the definition of property, plant, and equipment in this manner. Okay. And at the end of the day, it's being written in such a way that you hardly find it 1 minute to revise. Okay, tangible, benefit, production, use, delivering goods, resource that I control. It's so easy for me to revise. Let's talk about the measure, how to measure them in start. That means initially acquisition date, and subsequent means the date of reporting. Initially, at what value we are supposed to record. Subsequently, at what value we are supposed to record. The word subsequent means reporting date, which can be the first reporting date, second reporting date, third reporting date. So initially on the date of reporting, how do we have to measure them? Initially at cost, subsequently either at cost or the revaluation. The basic difference of two models here, the assets are kept always at their historic values. Whereas in the revaluation model, the assets are kept at their market value. So every year end, when the market value changes from the last year's market value, we keep on revising. That is a basic difference of two. Both the models, they will have that depreciation come that has impairment. In detail, we will have to come and talk about these two models on the next page. But this page at least introduces that, okay, initially at cost, subsequently either at cost or a re-evaluation model. And the components of cost model, they start off with cost, obviously. Takes the depreciation very next to, and impairment loss into the last. Now this impairment loss thing, let me highlight and to clarify to all of you. We will be working not in this standard. This will have its own separate standard. We will be doing that into chapter 7. So when I go to defer something, I always come to give you the reference of that. Look, in this chapter, we will do it. Chapter 7. So being a part of this model, I have been able to at least write it because it's one of the component of these models. But what is it? Least bother in the course of today. Rest we can talk about. We can talk about what is cost. We can talk about what is revalued amount. We can talk about the depreciation. But impairment thing is an advanced topic. We will be doing that into chapter 7. Probably after 2 courses, we will be on. So initially at cost, subsequently, either we can continue with cost or this is totally a choice, or we may go to value it. Once we have chosen to apply a valuation model, we will have to keep on updating the value of the asset in response to the change in the market value of asset, because market value keeps on changing. It does not stay same throughout. So we try to bring it the same into our books. But when we go with the cost model, regardless of the fact what's happening into a market, we keep the asset always at its historic value, which is usually a purchase price at which asset in the past was being purchased at. So like I said, this page just introduces. We have a detailed explanation of, first of all, cost coming to our what is cost, detailed explanation. And then gradually I will take you into a detailed explanation of depreciation. Then we will be able to look ourselves into that valuations. All is planned in the course of today. The first page of that itself has ended. Initially at cost, subsequently either at cost or the market value. Both models, they will allow an asset to depreciate, impair, while the topic of impairment is not being the part of the topic of today because it's just another standard, another chapter. Rest we will definitely be able to talk about. What is the definition of property, plant and equipment itself? Tangible, non-current asset held in the business for use completes the definition of property, plant and equipment. And you have got lots of examples. You have to have it with you in your mind that you need to pass them through to these 4 parts. In the end, you will be able to say them, yeah, these are the property, plant and equipment. Taking an example of a retail premises is a property, plant and equipment of that business. How? Because retail premises is tangible. It can be seen, it can be touched, it can be felt. It does have a physical substance. Provides the benefit for more than a year. Definitely it's a building. The life of that will be at least about 50 odd years. Non-current. Controlled. Like I said, they own that building. And that building, they always have a control over to it. And they are the one getting the benefit out of that, no one else. By having a display center into it, they sell products and they have a full control over to it. And why do they keep that building? To sell it to someone. They keep it for themselves, to provide them with the benefit of service. Service is what? Conducting their business operations into it, displaying their products into it, so that the customer, they walk in and buy the product. So they're using that building every other day, 24/7, 365 days a year, definitely will be a property, plant and equipment. Hope I have been able to make this whole thing a lot easier than it was before. Because in basic studies, you usually do not bother to look into the definitions of the topic so much, or if you look into, you try to cram those definitions. But here, it's not required. A sense has to be understood, not the definition to cram. And the more, the better definition you can remember it, you will be, examiner will be impressed. You will never be asked to write the definition. So to understand it, know the meaning of each word, and then try to pass through many examples through those parts and call them to be as PPE or not, just for the sake of your confidence and your comfort that, oh, I am being able to call them as property, plant and equipment, because I have been able to pass through this one example to all those four parts, and I find them to be property, plant and equipment. Let's take ourselves into a cost model. And within the cost model, the discussion of the cost, which is on next page. Detailed explanation is coming to your way. Maybe part of the explanation you have done it in the past, but now again, you will see it the way this course requires you to. So what is cost? Even I have been able to segregate the cost into its two components, initial cost and subsequent cost. Let me first tell you the difference of these two types. Subsequent, as the name suggests, these costs are incurred in the later years of the asset's life. For example, you, after 2 years of asset, you may have now decided to repaint the walls, or you may have decided to construct one extra room in it. So what is happening is now subsequent, because this is about after 2 years of purchase, you are bringing it something in today. You're incurring the cost to repaint the walls. You're incurring the cost to bring to extend it. So all of those costs, those are incurred subsequently in the later years of the asset, are called as subsequent cost. Again, that does not have any bookish definition. The word subsequent says it all itself. While the word initial means the cost that's being incurred for the first time to purchase an asset and to bring an asset to its workable state. Bring an asset to its workable condition. What does that mean? Bringing an asset to its workable condition. What does that mean? Serviceable condition, usable condition. What does that mean? See, the assets, the businesses they have, they are the bigger ones. So time to purchase them and to bring them into your business and to make them used one day can take number of days. Not you buy a machine, next hour it was delivered and you start using it. No. Think of a machinery. You may have acquired a month ago and it has taken about a month coming to your place, because a lot of things on the way were planned to take place, like shipping of that machine, first of all. Then arriving at your premises, it was needing to be unpacked. Then it was needing to be installed. So that probably has taken about 15 odd days So all of that cost you have incurred in the last 15 days to bring that asset today into a workable state is the cost that we call it as initial cost. Because straight away after purchasing, you cannot use the asset. It's a big asset. It requires to have a lot of protocols to follow, taxes to pay, maybe legalities, some duties you have to pay if it has been purchased from abroad. So you might have to pay port taxes, custom duties to get a clearance. Shipping cost will be involved, installation cost, and then one day you will start using. So all of that cost that has been incurred during that process is called as initial cost. First time incurred to make that asset workable. Well, the basic component of cost obviously is going to be a purchase price. One cannot. Purchase price obviously is the major ingredient to start with. And then you can see the list. So let's go to even understand that list, not by cramming it, but getting the better sense of that. So purchase price is the first thing that should form a part of a cost. Less trade discount. Yes, trade discount. As there are two types of discount, the other one is called as settlement discount, which at times is also called as cash discount. Ignore it. Now, ignore means not to do anything. Even if the question states the settlement discount has been availed, you should not still be taking it. And I can tell you the reason why, practical reason of that why. What is trade discount? Trade discount is a part of a trade policy. The trade policy was that whoever will buy an asset will get 10% discount. So everyone who goes to buy an asset gets the discount and price reduces down to 90% immediately. Price reduction. I mean, as far as the seller's perspective is concerned, it's the reduction in price. So if I'm a buyer, so I will end up paying 10% less. So that's the reason why it's being deducted. I will end up paying 90%. So it will immediately reduce the price on the date of payment, because it's a part of trade policy that the business offers it to everyone around. Whoever will buy an asset will get 10% off. So I have bought an asset, so my price has been reduced by 10% and I've ended up paying 90%. It was their trade policy. You also can apply to my courses. The price that you have paid, if on that specific day there was an offer, so you have ended up paying 90% of the course fees. Some might have paid full, because the time that they have purchased the course, there was no policy in place of discount. Realizing it or not, so you see, everything you come across to learn, you try to apply to your own life. Yeah, I've experienced that. That although I have paid the full price, but then I have checked it later on, the business was offering a 10% discount on weekend. So for those they have purchased the courses on weekend, being the part of that institute's policy, has ended up paying 90% price. So it's just the policy the trader can have, and whoever will fall into it will end up getting that discount. And the price has immediately been reduced to 90%, and they have ended up paying 90% in comparison to those they have fully paid 100%. So that is trade discount. Immediately reduces the price by 10%, 20, whatever the policy that they have, for example, 10% discount. And it's applicable to everyone, not selection. Whoever has come to purchase an asset when the discount was available, everyone will get the benefit out of it, not to selected customers. Whereas settlement discount usually offered to selection of customers, not to everyone. Or can be to everyone, but it's like a discount where they say that, okay, the normal credit term is 90 days. But look, if you pay me in 1 month, I will give you 20% discount. So it's like an offer. You as a customer might not accept, might accept. It's not sure that the price will be reduced. Trade discount is that kind of a discount which immediately reduces the price, and everyone who comes to pay gets the benefit out of it, being a part of trade policy. But settlement discount, first of all, is offered to the selection of customers. I will choose, suppose 10 customers out of my 100 of customers, and I will give them the offer. Look, pay me in next 1 month. Although your credit term is 90 days, but if you pay me in 1 month, I will give you 20% discount. Now, the customer might avail it, the customer might not. It gets confirmed on the date of settlement, never on the date of purchasing an asset. That's the reason why, while computing the initial cost, it cannot be considered. Because the nature of the discount is of a kind that the confirmation of that is usually certain number of days after settlement date, 30 days after, 40 days after. So while working the initial cost, it cannot become the part of this cost computation. Initial price determination, it cannot be a part of it. Yes, even if the question says that the settlement discount has been availed, still you will not consider it. Because again, the settlement discount has been availed a month or two after, suppose. But while working the initial cost, standing it on the date of the purchase of the plant, that discount was never been confirmed. Later it was availed. So this is the mistake that at this level, even the students, they do it. And even if I'm not going to emphasize onto that this way, you will still end up. Because examiner will trap you. And you will easily be trapped if you will not pay attention to these important things. So price less discount. Which discount? Trade discount. Settlement discount will be ignored. Even if the question suggests they have availed the settlement discount, they have not availed the settlement discount, regardless of the fact. If the settlement discount is given, you just need to ignore that. Trade discount definitely needs to be taken to reduce the price. Moving on to the next. Taxes. If the machine has been purchased from abroad, you know that it has to come from another country by airport or by shipping through airport. At both the places, to bring that asset into your country, to let that enter to the border of that country, definitely you have to pay a lot of duties. And these duties are non-refundable. Else, your asset cannot enter that border. You will not be able to release that asset from customs unless or until the duties are clear. So paying the duty or any sort of taxes, related taxes, is a cost to you as a buyer, because these duties are never refundable. And you incur them just because of the reason of purchase of asset, else you would have not incurred. Fine. Or you would have saved those if you had not ordered an asset. So the incurrence of this cost is due to the reason of purchase of that plant. So specifically, it will be added into the cost of that plant. Sometimes the sales tax is also involved, the value tax. But the value taxes are commonly refundable to registered businesses. So if the value tax is not even refundable, then it will be topped up also. So the word non-refundable, I have been able to write whatever the type of tax that is non-refundable will fit in. It can even be a value tax. But value tax usually refundable to businesses since they are registered businesses. But even if the business is not registered, or it was just a single person, so even paying the VAT in that case becomes non-refundable. So it will be added. Then comes the transportation. Now you will have to bring that asset from that shipping port or from airport to your premises. And it definitely will require you to incur transportation, handling charge, delivery cost, in simple words. So far, the asset is still not in a usable state. It's still on the road, on that vehicle on which it has to be delivered. It's not in use at the moment. You're still incurring the cost, so that one day it will start working. You're still on the way. Finally, it has arrived at your premises. What next? Installation. And because of that, a preparation of site. You must have to bring that site into that state that this plant can be fixed upon, because that site is originally not in a condition to install the plant at. So you must have to incur the cost to make that site feasible to install the plant. So all of these costs being incurred, being the part of that installation. What next? It can happen, not necessarily all the times. Who has to come and install that plant for you? Sometimes the vendor provides you with this sort of facility that they will come and install the plant by themselves. So they will bear the cost of installation and all those burdens. But in case you by yourself has to install it, and you do not have that technical skill, so you'll probably hire engineer or technician to come and install. So that technician or engineer will take a consultancy fees or not. So everything is revolving around the care of that installation, where technician will be involved, site preparation will be involved, just for the reason of installing that plant. Or if you have used your own labor to install the plant, so in that case, the labor cost even will be capitalized. The labor cost is expensed out. But when the labor of your own is involved in installing the plant, then it becomes a part of installation cost, and installation cost then will be capitalized. What next? Don't you have to test it? Today the plant is installed, and the next moment I will start working on. No, first of all, I will have to give it a bit of a try. I will have to test it maybe for about a day or two, or maybe about a week or two. I will test it. It's a huge machine. Can't take a risk of just starting to work commercially on. I will have to definitely put this plant for a week on a trial. And obviously my staff needs to have a training to start using that plant. So this trial run cost, test runs cost, without incurring this cost, you cannot still make the use of that plant commercially. So test runs cost will even be capitalized. Test runs cost, what will be involved in test run? Materials cost will be involved. Labor cost will be involved. Overheads will be involved, because for all those 7 days, you're going to put that machine on a trial. Labor will be working on to that machine. Materials will be involved. The overheads will be involved. So test runs cost will also be capitalized. And finally, after it has been tested fine, the very next day, the plant will be in a workable state for your commercial use. See, that is the whole process of remembering. Cramming is not a solution. Try to stretch up this whole example in your mind, and part by part, step by step, you will be able to remember this whole list of costs. There are certain costs I yet have to comment on, but not necessarily they will be a part of this cost calculation all the time, but they can be. I can have a discussion, but till test run, all the cost will be capitalized. After test run, this plant then will become in a usable state. Own labor cost, I already have told you that if your own labor is involved in installing the plant, or if constructing, then own labor cost will be capitalized. Because this time your labor is not doing the labor hours in producing the products. This time the labor is conducting the labor hours on constructing a plant itself. So it then will become a part of the cost of plant. The labor cost means the salaries of the staff, then the wages of the labor will then not be expensed out. It will rather become the part of the cost of construction of that plant. So if self-constructed or if self-installed, then the labor cost will then be capitalized, not then will be expensed out. Borrowing cost. Very interesting. Borrowing cost means interest. Interest cost, the same thing you call it as finance cost. So if you have borrowed a money and using that money to construct a plant, then all the interest cost that's being incurred on that borrowing will even be capitalized, interest cost. But for this reason, we have to respect another standard. Exactly how to capitalize, when to capitalize, we will come to see it very formally into this topic the next week. IAS 16 only has referred that, look, borrowing costs can be capitalized, but look, you will have to consult its respective topic first. IAS 16 has just stated that the borrowing cost can be capitalized, being the part of the cost of constructing the plant. But for that reason, you have to take the permission of IAS 23. And what is that? In a very detailed manner, you will come to see me talking about this standard the next week. Because capitalizing the interest is not a normal thing. We always have expensed interest. Capitalizing the interest is a very rare treatment. So when we are allowed to capitalize, to what extent we are allowed to capitalize, criteria, and then computation, all will be seen in the next topic and next week. And then comes the future site dismantling and restoration cost. What is it? The word future is, it's the only cost which will be incurred in future, not today. What is dismantling? In easy words, dismantling means unfixing or uninstallation. Just the way you install the app and then you uninstall it. So today I'm installing a plant. For 10 odd years, I will use it. And then after 10 years, once I will have to replace it. So I will have to uninstall it. So that is called as dismantling. And you can see that why this cost has to incur in future, because dismantling is going to be after 10 years, not today. And restoration cost is cleanup cost. Today, I have prepared the site in a way that this plant can be installed at. After 10 years, once the plant will be dismantled and I will have to do another task onto this site, so I will have to restore it, the site, to its original state. Both of these costs are in the future. So we will come to look into this more into our another topic later on, which is the topic of provision. IAS 37, future site restoration and dismantling cost is capitalized, but the computation part of it, the corresponding effect of that will be studied in detail in IAS 37, chapter 13. IAS 23, we will work it the next week itself, but this is going to be a little later, chapter 13. This topic will be worked in. This is the way you must have to learn things at this level. So much of in depth and everything crystal clear. And it has a story in the back. Not just I'm reading it out and wanting you to just read it for about 5 times and try to remember it. The way this example has been put in the backward, you will never forget. Certain costs cannot be capitalized. Abnormal wastages. Sometimes when you are constructing your own plant, so there are wastages. So abnormal wastages are those are more than to what you had expected. That is normal wastage. See, normal wastage is what you already were expecting, that this sort of waste I expect will happen when I will construct a plant. But abnormal is more than to it. So abnormal waste cost will be expensed out, because that is not considered to be as normal thing, abnormal. And errors are not capitalized. Same way, the rectification cost of errors is not a planned cost. The error you cannot plan. If you have planned, you would have not done the error. See, if I can plan tomorrow, I may do an error. I will not do that error tomorrow because I already have foreseen it. Mistakes, errors are never planned. During the construction, during the installation, my staff may have made an error. Now to fix that error, they have to incur extra cost. This extra cost was never planned, was never in budgets. They never had thought of that these costs would ever incur even, but now because that has incurred. So because the nature of these costs are unplanned, unforeseen, they are expensed out. They're not capitalized. Because these costs are not normal to construction. These costs are not normal to installation. These costs are rather exceptions. May have incurred this time around, next time around, never it would happen. Are you understanding? See, this cost is not within the normalities of constructing the plant, installing the plant. Exceptionally, this time it has happened. Not every time it will happen. It had happened in the past, never. So because of this nature of cost is unplanned, unforeseen cost, we expense them out. We're not allowed to capitalize. Let's go and take this whole talk in a one go quickly. And then we have one question on that to perform. So I started off by taking the purchase price, which will immediately be reduced by the effect of trade discount. Since trade discount immediately brings the price down. Settlement discount, even if the question suggests, ignore. Why? Because settlement discount gets confirmed several days after. Because the plant was purchased from abroad, so to bring it into my country, have to pay taxes at port, non-refundable. And many taxes other than that, those are non-refundable, will be added. Shipping to my premises, transportation and handling cost. After it has arrived at my premises, installation, that will make me to incur site preparation cost. That will make me to hire an engineer who has to come and install the plant. So professional fees. If my own labor is involved, so my own labor cost will be added. After it's been installed, I must have to test it. So test runs cost. If money was borrowed and the money has been used to construct that plant, the interest cost can be capitalized, being the part of the cost of plant, as long as the IAS 23 will allow. Future site dismantling and restoration costs will even be capitalized. This way, you should have to remember this. No better way to remember it except this whole example. Try to create the whole story in your mind, and then remembering all of those points will become an easy job. Let's go to work one question. Up till now, what we have learned, we can test ourselves on. See, these questions that I'm going to work from the lecture notes are topic specific. The word topic specific means these applications, they're not exam level type questions. These rather cover only the part of the topic that we have finished. They require us to revise it by practicing. See, the requirement of the question is exactly what we have just done. They say that calculate the amount at which the initial cost of the plant should be measured. But that's what we have been in debate of from the past 15 minutes or so, or not. Ignoring discounting. Broaddock has recently purchased an item of plant for Plantco. Now, by the way, there are two types of examples you will find into my lecture notes. The one is called as illustrative example. Please watch it. Illustrative. The other one is called as learning. Can you see the difference of both? Apart from the word illustrative and learning, because immediately what will click? The color of it. This one is white, transparent, with no background color, where the learning example is the one in the gray color. Colored one is learning example. And simple one is illustrative example. That's going to give you an immediate clue of which example you have to be on. What is the difference of both? Illustrative example illustrates the whole case. That means it does have a question, it does have a solution all together in. But learning example is just the question, while the solution of that I will produce. And even the solution of these examples are there at the back of the chapter. But I will be working all of those learning examples on the whiteboard. Fine, getting to know your lecture notes as everything that's going on. A lot of things you're getting to know for the very first time being the part of your course. Okay. Broaddock has recently purchased an item of plant for Plantco. The details of this are as follows: basic list price. Then they suggest trade discount. The word trade is important. In salary cost means additional cost, like shipping and handling, pre-production testing, maintenance, site preparation cost. The breakup of that shows electrical cable installation, concrete reinforcement, own labor cost. Broaddock paid for the plant, excluding the ancillary cost within the 4 weeks of the order, thereby obtaining a settlement discount. See the word settlement discount of 3% within the 4 weeks, and they have obtained. So they are giving us all of those traps for us to take, but we will not take it because of this reason. 4 weeks. The day that we are standing today on is the day of purchase of plant. And the day they are getting that discount is within those 4 weeks at any time, could be in the next 2 weeks time, 3 weeks time. So practically not possible to consider it being the part of the day of purchase of plant. This definitely we will take. And I will also have to come and tell you that if we are not going to take the settlement discount, then because we have obtained, so somewhere we have to come and account for this. So where do we have to account for this when they have obtained the discount and we are not considering it to be the part of the computation of cost? Then where are we supposed to take it? Then I will explain to you. Somewhere else, but not being the part of the computation of the cost of the plant. Broaddock had incorrectly specified. Now, incorrect specification is an error. And looks to me, they have to come and fix it now. The cost of correcting this error is 6,000 and is included in the above figure of 14,000. This is what I was talking about. This error was never planned, but now because they have committed, so they have to fix it. They say that the cost of correcting this error is 6,000 and this has been included in the above figure. So where do we have that 14,000 somewhere? Do we have it 14,000 somewhere? Yeah, over here. So let me write that this 14,000 includes 6,000 from the rectification. Imagine this error had not taken place. This cost would have not incurred. But because the error has taken place, so they had to fix it, so they had incurred. And the error does not take place every time, or may have not taken place in all those past installations, or may have taken place which may have required me to incur more than to that even. But these things, you can't even write them. It's just unforeseen, it's just unplanned, and you can't even have a clue about. Imagine the 6,000 cost they had not incurred. The normal cost of installation would have been by 8,000. Means if this error had not taken place, they would have incurred 8,000 to install the cable, which is a normal thing. But that extra 6,000 that this time they have incurred is not something that they had planned, they had foreseen. So that is the reason why the unplanned sort of costs are always expense. They are not the part of the budgets. The plan is expected to take for 10 years. At the end of the period, there will be a compulsory cost of 15,000 to dismantle the plant and 30,000 to restore the site to its original state. Now, this is the dismantling cost and site restoration cost. Nothing in this question has been tested out from this explanation that I have it. We just have to come and make the list and find the total to it. starting off with the list price. So this is learning example 5.1. Starting off with the list price, which in this case is 240,000. I will reduce it by the effect of the discount, which is trade discount. It's 240,000 multiplied by the percentage, which is given as 12.5%. Takes the whole thing down to 30,000 or by 30,000. Fine. Then comes the shipping and handling cost, which in this case is given as 2750. And then comes the pre-production testing, which is a test runs cost. In the case, it's been given as 12500. And then comes the maintenance contract. Okay, maintenance cost. Should we have to capitalize or do we have to expense it out? Based on our understanding from our past courses, we always have learned that the maintenance cost cannot be capitalized, rather expense them out. So yes, we're not capitalizing. But the good thing is that now I am going to explain to all of you why not. Because at this level, it's not just good to remember maintenance cost expense, better to understand the whole logic behind why not. So much required at this level. And everything that I have explained it to you up till now, with a proper reasoning, not just putting that list in front and asking you to cram it. Never I will ask you to do that. Everything needs to be learned by its sense, by its logical reasoning. So let me explain why the maintenance cost, never in the life you have ever capitalized and you always have expense, repair and maintenance cost. First of all, this maintenance cost I haven't taken into my discussion because maintenance cost is not initial cost. It's this thing. And that area I have not yet talked about. The reason why this maintenance cost has not come into my debate as of yet, because I was just concentrating it on initial cost, and maintenance cost is not the initial cost, it's subsequent cost. So let's take that moment. Let's take this moment to also cover this side. So subsequent costs can either be capitalized or can be expensed. Now, what makes us to say this will be expensed, this will be capitalized? Once again, we do not have to cram that, okay, these 4 to 5 items are to be capitalized, these 4 to 5 items not. No, again, we have to have some logical reasoning behind. But yes, subsequent costs can at times be capitalized or at times it will be expensed. So what makes us to say this subsequent cost is capitalizing? This one is not capitalizing, rather expensing. There is a criteria we have to look into. This criteria, the essence of that criteria means the cost should add value to business. Should add value to the business, then it will be capitalized. If it does not add value, it will not. Let me make you understand the meaning of this word, adds value to business. See, if I have a building, a 5-story building, wherever it was being constructed or purchased previously. Since then, it has 5 stories. Originally, it's a 5-story building. After 3 years of purchase, today, I have decided to construct extra 2 stories over and above to the existing 5 stories. So constructing the cost of 2 stories, first of all, is a subsequent cost, because that cost I have incurred today after 3 to 4 years of purchase of that building. I have been able to construct extras 2 stories today. It's a subsequent cost. But constructing the extra 2 stories will add value to business. How? Many ways. I can double the operation, means I can double the machinery, double the output, and double the sale. Extend it. It has extended the overall capability of business, capacity. If I had been selling, suppose, 1,000 units a month, now I can start selling 2,000 units, maybe even more than that. Since my factory is doubled, the machineries are doubled, this definitely will double my output. If not double, at least will be more than to what I used to be. Because now I have 2 extra stories to accommodate more machinery, to accommodate more staffing. Or even if those 2 stories, I could simply let them out to get rentals from. So getting the rentals, which never had been the case before, is going to add value to business. Extra income. Think of that. So if any cost that you have incurred adds value to the business, earns extra for the business, will be capitalized. And that's the reason why always previously in your courses, you had been capitalizing the cost of enhancements, extensions, improvements, because all of these will take you towards adding the value to the business. But after 2 years, the same 5 stories, if I decided to refresh the paint of 5 stories, you think that refreshing the paint of 5 stories can bring me extra to business? No, it will maintain the same earning capacity that originally this building has, but it will never go to exceed that because I haven't increased the workspace. I haven't made my workspace to be looking more bigger. It's the same building which I had since the start, and I have been able to refresh the paint of it. It's repainted. So repainting the building after 2 years is an example of subsequent cost, but that subsequent cost is not going to add any extra penny to business. It will rather maintain. That's the reason why always in your life, repairs and the maintenance costs are always expensed. Because of this criteria, that probably for the very first time, you have come to learn it. So adding the value to the business can be achieved in many ways. This is the example that I was giving to you. Increase production capacity, double the factory, double the production, double the sale. This can also be the way, extending the useful life. So the machinery that I have got about 3 years to run now. But I come to install another part in it. Based on to it, now the machine and now can start working for the next 5 years. So the life has been extended from 3 to 5 years because I have just installed a new part in it. The remaining 3 years now have gone up to 5 years. So the life has been, so this machine now will give me extra 2 years of benefit over and above to 3. That can be the way that this can add value to business. Or this also can add value to business by improving the quality of output. See, quality of the product when is good, you can expect more customers to line up for your products. And you know that why? Because you as a customer, when you go to buy items, food items, so you prefer to buy that item more often that you consider it to be of a good quality. Maybe a clothing item, the food that you prefer it to eat, the motor car that you like to drive, the cell phone that you like to use, whichever the brand. So when the quality of an output is better, so you can expect in the future more sale to come to your way. I can give you one example also for this. In the airline industry, for those they have an experience of traveling, you know that there are usually three classes: economy class, then you have business class, and then you have first class. So in the recent past few years, for some airlines, now they have tried to introduce a premier economy. Now, what is premier economy? It's not a business class, it's not even economy, it's in between the two. It takes few benefits of business class and it takes few benefits of economy class. So it's called as premium economy. Now, what is in premium economy? Now you will get more leg space, maybe more better meal facilities, but not as comfortable as the business classes, but not as discomforting as the economy classes. It takes the benefit of both. But based on to this premium economy class, they have been able to increase their airfares. Since if economy class, they sell out for $1,000, suppose, then premier economy, they might have started selling it for $1,500. So $500 extra for each ticket. So because the quality of product they have improved, economy class has been improved to premium economy. As a result of that, they have been able to raise the airfares. So with more airfare, for every ticket that they will sell, will add value to business. This way, if the subsequent cost brings the benefit to the business, the subsequent cost will be capitalized. That pretty much even ends up the talk of the subsequent cost during the question itself. I hope you already have understood based on to the amount of examples I have put forward. Now we can be back to the question to try and finish. Electrical cable installation. $14,000, but we will only go to take 8,000 as a result of this error, which is costing them around 6,000. So we have to exclude it. That cannot be capitalized. 8,000 will be capitalized. And we have concrete reinforcement. $4,500 will come in as it is. And then comes the own labor cost. The own labor cost is $7,500. Settlement discount, totally we need to ignore. On the next page on the top, we have got future site restoration and dismantling cost. Future dismantling cost and future restoration cost. It's given as 15 and 3,000. Okay, so this is that initial cost at which this plant will or have been capitalized. Want me to find the total of that? Okay, we can do that, not a big deal. 240,000 minus 30,000. 240,000 minus 30,000 plus 2750 plus 12500. 263,250. So it's not just about finding the total, it's about what you're taking, you are dead sure about that it's going to come in or it's not going to come in. Like I've not taken a maintenance cost. So I knew it's not going to come in. I'm sure about that. If I've not taken 6,000, I know that this will not going to come in. If I've not taken a settlement discount, I know that it's not going to come. So it's not at the end of that, it's not about just finding the total, because you can find the total maybe by spending few seconds on, but as long as you have taken old components or you have skipped those you're not supposed to take, this is the cost which is going to be capitalized. But now we can go and make the list of those costs. Those are not going to be capitalized, rather it will be expense. The first one on the top of the list will be a maintenance cost. What was the maintenance cost? The maintenance cost was 24,000. And for 3 years it was. And 3 years it was. But when I'm going to expense that out, I will be taking only the year's cost. You cannot violate the accruals concept, recording the maintenance cost of all the 3 years into 1 year's profit and loss. So XP also, what about matching concept? Only that is maintenance cost. You can expect to expense it out, not the whole 24,000. Or else this 24,000 was only for this year itself. But that they tell us about for 3 years. The second thing that's going to be a part of that list, remember that rectification cost, which in the list above, we have not taken this one. Expensed. Third thing that will come in is settlement discount. There we will go to record this discount as an income to us, discount received, which has to offset amongst the list of all of those expenses. The rate of that discount was 3% and will be multiplied to 210,000, this figure, to get that answer. Fine. Okay with that? So if the question suggests that they have availed the settlement discount, you will rather come to record the same thing into profit and loss as an income, which will offset to the other list of expenses. Like in this case, you people have seen me offsetting it against. Okay with that? Now, this is that figure, which I am going to write it as the figure of expense. Okay with that? See how extensively that explanation has come to an end. This can give you the flavor, the taste of what you expect to see for all those next 4 months to come on each topic. If this page was only to be read, would have taken us about not more than 5 minutes. Or if I only have to casually say that this thing and this, you will consider it, would have finished this off in about 5 minutes. But every little thing on that page, top to the bottom, every corner of that page has extensively been, rigorously been understood. Logical reasoning behind on everything, why we have to take this, why do we not have to take this. Lot of examples I gave it from the practical side, so that it starts making a sense to you. This part was not originally being explained, but during the question when I was solving, I also came to finish that part. It's pretty much ends up the talk of the first component of model, cost model, which is the cost itself. Have you in the past have learned this standard the way that we are learning? You will definitely see the difference. This will allow us to finally step ourselves into the next component of cost model, the depreciation. Now, the depreciation is not just for this model only. This depreciation thing is applicable to all of those models which we have to study with all those lectures to come. But the discussion of that is only once, which is today. As you can see that the depreciation has been the part of this model. So whatever the debate we will do, this will be valid to this one also. So it's not just for this model. It's applicable to every model we will have to cover in this topic, next topics. The discussion will remain to be the same. So let's start ourselves with the depreciation. Yeah, if I have to show to all of you a little the way in the detailed lecture notes, the things are written, you will not be surprised to see so much of the text is there. See, we've been discussing on initial cost calculation, and see how the way in our detailed lecture notes things are written. The tangible non-current assets are initially recorded at cost. Now, what is cost? Start reading it. Purchase price less trade discount. And then it says, but before settlement discount. Once you come down to read this page, you will have that feel that I know all of that. Because the lecturer has explained me from his live course explanation, from his board explanation, from his summary of standard, and it's easy for me to just read it. See, non-refundable taxes, site preparation, installation cost, professional fees, self-constructed, own labor cost, borrowing cost, future site dismantling, restoration cost. Then, in regards to subsequent cost will be capitalized when it adds value to business. Same three conditions: extending the useful life, improving the quality of output, extending the capacity. Same three. A component of asset is treated separately for the purpose of depreciation when it is restored or replaced. This I will come to talk about in a while because we have not yet talked about this depreciation thing. Any subsequent expenditures like repairs, maintenance must be expensed to the profit and loss in the year in which those costs are incurred. That we already have done. Followed by this question. So your detailed lecture notes are not as detailed as you find them hard to read it. Sample wise, I have been able to show to all of you what's there. But you have to develop this habit of making sure that you read every page of it. While the first page of that writes nothing, the definition, which I already have done. Check this out. Tangible, held in the business for use, expected to be used for more than 1 year, which means non-current. This is the first part. This is the second part. This is the third part. Well, the definition of asset, broadly speaking, I already have explained. Held in the business. Goods for rentals to others and administrative purposes. This is where I have given lots of examples to you that for production, we have machine. For delivering the goods, we have motor cars. For rentals to others, we could have a building. For administrative purposes, we could have tables, chairs, office fixtures, and all. And this topic is all about learning these things. And gradually we are learning all of it. The cost we are just done by, and we are about to start off it with the depreciation. So let's take a break for 10 minutes. Once I will resume the session in about 10 minutes time, I will be having a detailed talk about one of the important explanation for all of those time to come. This depreciation is not going to leave us aside. So stay tuned. I will see you in about 10 minutes to continue the course. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. We were about to start off with the depreciation. It's the topic which you people have done it in the past and you're confident about that but still a lot of things and the way that I have to make you understand this might be a new experience for you. So kindly, I require to have your full attention and respect towards this topic. Let's not forget the depreciation is a second component of cost model. After completing our detailed talk on to cost, now we're getting into that depreciation. Now, depreciation is an application of matching concept. Is an application of matching concept, which requires the cost to be matched with the benefits, that you should match the cost to the benefits in the year to which they are related. In whichever the year the benefits have started flowing towards the enterprise, the cost should be matched up with in the same period in which the cost was incurred to bring those benefits. That's the basic concept of matching, as the name suggests, matching. To match the cost with the benefits to the period to which they are related. Now, how does this apply to the concept of depreciation? Systematic allocation of depreciable amount over an asset's useful life. This is the bookish definition, which again, I will not be wanting you to cram. Rather, understand the whole essence of it. See, an asset brings the benefit to a company. Let's try to prove this statement. I was giving you an example of laptop initially in the start of the course. This laptop is an asset of my business and it brings me the benefit. It has been in the past, it is, and it will be. So this way you at least can be sure of that it's the laptop, it's the asset that brings the benefit to the business. Is it proved or not? All the assets that I have in my workspace, the iPad, the microphone, the lighting setup, the tables, the chairs, and all those fixtures, those are around you. They contribute to bring me the benefits out of this business. Is it or not? If I don't have these assets, no benefits I can expect to get. And I have incurred a cost in purchasing these assets. Is it? I have purchased this laptop, I have purchased this iPad, this lighting, this aircon and all. Cost is incurred. So how can I match this cost with the benefits these assets are bringing to business as a result of depreciation? Now, the problem is that the benefits, they just don't come in 1 year. They come in number of years, 5 years, 10 years. And the cost I have incurred today in buying this laptop. So how can I match the cost of buying the laptop with all those benefits this laptop will generate in 5 next years? Because cost has just incurred one-off today. Benefits are not just 1 year. Benefits will be for the next 5 years. So how can I match the cost with all those 5 years of benefits I can expect to get out of this asset as a result of depreciation? So we do not record the whole cost into profit and loss of first year. We rather spread that out by the way of depreciation. Remember, cost divided by useful life. So the cost, when being spread out in 5 parts, each year we go to record 1 part. And then this way, the cost is matched up. This is the basic sense of why do we depreciate an asset. Maybe never any one of you have explained this to you ever. We try to divide a cost over its life so that each year there is a benefit to match it up with. Application of matching concept is satisfied, fulfilled. And then we can use many methods. Reducing balance method can be used, straight line method can be used, double declining method can be used. There are a lot of methods, but ultimately, these methods, they allow us to take a small portion of the cost and match it as a result of expensing, depreciation. And we do that for 1 year, second year, third year, fourth year, fifth year, over the life. This is the basic essence of depreciation, matching the cost with the benefits. Benefits, they come number of years in. Cost you just incur today. So how can I match the same cost with all those next years of benefit? By depreciating, spreading the cost out over the life, making me to matching it with the benefits that the asset generates. It's a simple idea of depreciation. Depreciable amount, cost less scrap value. Now we know the cost from the previous page in detail, so let's not bother to look into once again. Residual value, it's the scrap value which I expect to get at the end of its useful life upon the disposal. Expectation. So I expect after 5 years, when I will retire this asset, I will be able to get probably $500 on the sale of it. That is called as residual value, remaining value, scrap value, salvage. Expectation, this is. Actual value can be more or less than to it. When the time comes and you actually throw it away, you might end up getting different amount, but on the day you buy an asset, you expect that after 5 years, when I will retire this asset, I might be getting $500. So this expected proceeds at the end of its life you expect is called a scrap value. Well, the useful life of an asset, again, is an expectation of yours. The period for which the business is expected to have the use of asset. The period for which the business is expected to have the use of asset. Expectation. The actual life of the asset can be longer than what you expect. See, my business policy is that we have a policy of replacing the computer systems every 2 years. That's the policy of the business. But that does not mean after 2 years, the laptop will stop functioning. You can still use that laptop for 5 years, 6 years, even more than that. But my policy was to retire this laptop every second year. So for that laptop, the life that is useful to me is a 2-year life. So it's the life that you expect to have the use out of it, not the actual life. Actual life can be much longer than that. It can be same as the actual life, but it can be different from it. That is a useful life. Good with that? So all those definitions are written on the left-hand side, right-hand side. I'm explaining to you of and going it smoothly on. Finally, I'm landing myself to the methods that those will be examined. The same typical old straight line method and reducing balance method are the two of them will be asked. There are many more methods, by the way, but these two are testable. These two are testable. Let's not straight away get into the computation. Let's try to understand the assumptions that these two methods are based upon. The first one assumes the asset provides the constant benefit. Constant means similar benefit. You make an assumption that this asset provides me the same benefit throughout. So I should come to depreciate the same over the life. Fixed charge needs to be worked, and every year I will have to go and record it. Because the idea is to match the cost with benefits. So when I have made an assumption that I'm getting the benefit throughout the same. So I should go to match the cost throughout the same. But in contrast to it, reducing balance method is more realistic to what happens to many of those assets. It says that when an asset is in its earlier years, or in simple words, when it is new, it provides more benefit than to its later years, because once it gets older, does not provide the same quality of benefit, even requires to have more repair work, restoration work, and the output becomes lesser to what it used to be when it was new. Happens to your car or not? A new branded car provides you a good consumption and mileage and the comfort. And once you start using it about a year or two after, you don't get the same as what you used to get in the first year of the car. Because machinery tends to physically deteriorate as you exhaust, you use it. So the life of that, by the time you use it further, the benefit that you start getting to get out of that is less. Same way you buy a laptop, when it's new, it's so fast, but now when you start saving a lot of data into it, a lot of things you start doing it in, then the computer does not provide you the same speed, the same smoothness that when it was so new. So you can relate what I'm talking about. Even when we are so young, we are energetic, but compare yourself to the one who is in his older age right now, cannot do whatever that you actually can do by being a younger self. So it's more realistic. When an asset is new, provides better benefit, more benefit. But when it gets older, reduces. So the same assumption, we use it to match the cost, that in the earlier years, you're supposed to depreciate more in comparison to its later. As the life will progress, the benefit will fall, the charge will also fall. So the name of the method is reducing balance, that every next year you step in, there's going to be a reduction in that depreciation charge. Both of them are testable and both of them are applicable, depending it upon the nature of asset. For example, building is kind of an asset on which this assumption totally works, because building is not like a machine. It's a building. It provides the same benefit that it was providing it in the first year. You get the same benefit in 25th year also, because it's a building. At the end of the day, same floors, same rooms, same stories, same capacity. It's not like a machine that after 5-6 years of use, it's now old and cannot provide you the same benefit as it was before. So both are applicable depending it upon the nature of the asset, but this is more applicable to those assets, those they tend to deteriorate both physically or technologically, like electronic devices, cell phones, laptops, all those gadgets, they tend to deteriorate technologically. Every new year, the new version of that cell phone comes in. So the previous version, then the demand of that, the use of that becomes less relevant when the new model comes in, because it brings in new features, more fast processor, more better camera quality. Maybe the light, it's more light, maybe it's more brilliant in its performance. So you can understand what I'm talking about. And then comes the methods of computation, which is, I guess, something that you people are, all of you are very much similar to it, but we should also go and look into that quickly once. Starts off with cost. As I have told you, scrap value needs to be deducted to find the depreciable amount. If it is given and you do not take, it will be a big problem. If it is not given, fine, then the cost will itself be a depreciable amount. Either you divide it by a useful life or percentage will give you the same answer. Key thing to notice is that this method is based on cost. And cost is because a historic figure. So no matter the charge is worked in first year of asset, in third year of asset, in 10th year of asset, you get the same charge every year, because cost is that one fixed figure. In no matter in which year you come to compute a charge, it gives you the same answer, since you're computing the depreciation based on historic cost, which does not change, which is the same one value. Yes. Sometimes the question provides you with the useful life, sometimes the question provides you with the percentage. Both will lead to the same results. If you're not understanding, then I can give you a few examples. Suppose if I have a policy of depreciating the machineries at 5-year life. This is the policy, that machines to be depreciated 5 years. The life of the machine is 5 years. So at what rate I should be depreciating the asset for 5 years so that it will fully be depreciated? At what rate? The rate is 20%, because 20% multiplied by 5 equals to 100% depreciated. Simple mathematics. If the life of the asset is 5 years, then for how many, what rate I should be depreciating the asset for 5 times so that it will fully be depreciated? Your answer has to be 20%, because 20% multiplied by 5 equals to 100% depreciated. So it does not make a difference if you are provided with the life or percentage, because both they will lead up to the same answer. Or in other words, if I say that, yes, the rate of depreciation is 25%. The rate of depreciation is 25%. So how many times should I depreciate this asset by 25% so that it will fully be depreciated? Your answer has to be 4 times, because 25 multiplied by 4 equals to 100%. I guess now you probably have understood. Or if the rate of depreciation is 5%, how many times do I have to depreciate this asset by 5% so that it will fully be? Your answer has to be 20 times. That 20 times is in fact the useful life of the asset then. It does not make any difference. The life is given, the percentage is given. It means the same. Whereas in the reducing balance method, net book value is used to multiply it with percentage, where the net book value is cost of an asset minus accumulated depreciation. What is accumulated depreciation? It is a pool of depreciation, like a swimming pool within which the water is pooled. Same way, it's a pool of depreciation where all the depreciation has been accumulated, pooled. The depreciation that has been recognized onto this asset for all the past 3 to 4 years, pooled in it. Now, every time when the depreciation will be charged, every time, the pool balance will rise. You put the more water in the glass, ultimately the level of the water in the glass increases or not. So taking an example of, this is a glass where there's already a water, and you put more water into it, so the level of that water will rise. So with that, the overall net book value will fall, because the more of the accumulated depreciation you pool it in, the lesser the net book value you will end up getting. And ultimately, when the percentage is based onto that net book amount, which already has now been reduced, you also will end up getting the reduced answer. So that's the whole science of getting the reduced answer every next year, because there we are working the chart based on to net book value, not on cost. Cost remains to be the same. Net book value will keep on diminishing, reducing each year, and the chart based on to that will even automatically reduce. how extensively, even the methods of depreciation I have been able to comment. The assumption these two methods are based upon, overall, what is the whole concept of depreciation, I even have been able to comment. We have one question very formally to work, and we should not mind working. Learning example 5.2. Let's go and have a look onto it and try to finish it off as soon as we can. They want us to calculate the depreciation charge, and the one that to be included into a statement of financial position for the year ended 30th of September 2008. The following figures are extracted from the trial balance of Telenorth. They have provided to all of us with the asset, right of use asset, plant and equipment, computer system. Right of use asset, if this term is not good to you, you should not need to be worried, because we will be learning this right of use asset into our chapter 8. Just right now, you will have to consider it to be as just any other asset. The cost of that is provided to us. And the respective depreciations are also provided, lease or building, plant and equipment system. So it's a trial balance. On the debit side, we have cost. On the credit side, we have. Telenorth has the following depreciation policies. Right of use asset on a straight line basis. Right of use asset on a straight line basis. And the leasehold, the lease life is not given. I can assume this to be as 5 years. Lease term is not mentioned, so I can write it to be as 5 years. Assumption. Plant and equipment, 5 years, straight line, scrap value is given, and computer system 40% per annum on reducing balance. Usually on IT equipments, the percentage of the depreciation is too high. And the reason why, because the IT equipments like computers, systems and all, they are subject to technological obsolescence. You try to depreciate them in about a year's or two time, because after 1 or 2 years, you might have to replace your IT equipments because of technological obsolescence. So their depreciation rate is always very high, almost 50% in the first year. You have depreciated, the remaining 50 might be the next year. Just saying, but these things are hypothetics, so it can be any. During the year, the right of use asset and the plant is to be recorded being the part of cost of sales. And the depreciation of the system is a charge to admin cost. So this is like, in the end, you must have to go and record this depreciation to this function of cost. It's a presentation thing. So I can make 3 columns. The first one for the building, second one for plant, third one for system. Building, plant, and this one for system. There I can write the cost, which is given. The cost is given as 56250. Plant is given at 55,000. And then we have 35,000. And we have accumulated depreciation. We have 18,000, 12,800. And then we have 9,600. So I have ended up working the carrying amounts, but I now have to come and depreciate for this year. Starting off with the building first, on the first, starting off with the building. And we will take plant on the next. And then we will take system. So for the building, I have made an assumption. The life is 5 years, so we will take 56250 divided by a life of 5, which is what I have made an assumption of, 56250. So 56250 divided by 5, the figure has to be 11250. And we have plant. They say that 5 years with a scrap value of 5,000. Let's not forget to consider taking the effect of the scrap value, which is 5,000 divided by 5 should be 10,000. And then we have system, which will be 40% of this figure, 35,000 minus 9,600, taking the 40%. So formality wise, at least we are taking all the boxes and not leaving anything aside, considering the fact that it's easy or it's small, covering every bit of that later, we will not be struggling to move forward. And with the confidence of that, we have done everything in IAS 16 in detail, in depth. Because I'm reminding you of that, whatever the thing that right now you're doing, it's not applicable to the course of today. It will have a long-term effect on many next topics to come. And we are making our life easier for that time and to feel better about that. We are revised with all of that in detail and with a lot of patience. Okay. Now, this pro forma that I have prepared, over and above to the revision of the methods of depreciation, remember when we later prepare the financial statements onto spreadsheet, this, like the note of property, plant, and equipment, will even be prepared. Means while you'll prepare the financial statements with me, or I will prepare the financial statements for you in constructed response question. In constructed response question. This is how the way the working note of property, plant, and equipment will be prepared. Lots of things will be involved also. Disposals will be involved, revaluations will be involved, but this how the way that pro forma will look like. So if I just had to calculate it, I would have just done that roughly this way. This figure, that figure, this figure. No, on top of that, also taking the care of something that you probably are not aware of, that this pro forma is like a preparation. For that time, when we will prepare the financial statements, you will be able to recall it, yeah, in a very nice columnar manner, a table of computation the lecturer has done. So that time, it will be easy for us to transform ourselves to constructed response questions onto spreadsheet. Then they want me to record the depreciation of the building and the plant to cost of sales, which is just like a presentation thing, as they have demanded. So the way they have demanded, I can just act upon. I can come to record the depreciation of first two assets to cost of sale function of head. And the administration cost will take the depreciation of last asset. So it will be 11250 and it is 10,000. 11250 plus 10,000, that's going to be about 21250. Okay with that? 21250. With that. So how nicely and in an extensive manner we've been able to complete ourselves with this whole the revision of depreciation, and it's not getting done yet. The many topics in relation to it we are stepping into, like this one in the bottom. On top of methods, there are some policies we also have to respect. Monthly, which is also called as pro rata, and the full in the year of acquisition, none in the year of disposal. Full means 12 months of depreciation, and none means no depreciation in the disposal year, full 12 months of depreciation in the acquisition year. Another policy. But more common nowadays is the first one, as I have mentioned. So what I can do, I can make a very simple example. And based on to that example, I can apply both the policies and you will see the difference. The cost of asset is 20,000. And the useful life that is given is 10 years. I also have to provide you one vital piece of information that we are preparing the financial statements according to our calendar year. Starts on Jan, ends on December. Also, the asset was purchased and disposed. The dates of that I even can write. The asset was purchased on 1st of May 2019 and disposed on 31st of August or 31st of October 2022. So the day an asset was purchased, the day an asset was disposed, I even have been able to specify. Now they ask us to calculate the depreciation for all those years involved. And we happily can. At least in the first place, we can work the depreciation charge for each of the year, which will be a simple task, 20,000. The cost, the life is 10. The figure has to be 2,000 per annum. 2,000 per annum. Now, the year of concern has to be 2019, 20, 21, 22. So the year ends on December 19, December 20, December 21, December 22. If I go by using the policy of months, let's take that on the first. Let me make a title of that monthly policy, or it's also called as pro rata. I will have to exactly count down the months the asset was there in the use, available for use. And these are the months: May, June, July, August, September, October, November, December. They are about 8 months. So when I will go to record this 2,000, I will end up getting this answer to 8 months this way. That's going to be about 133. This is neither the year of not the year of disposal. Now, in the year of disposal, the whole story will repeat. I will have to come and ask a question to me that, okay, for how long in the year of disposal it was being held out for? And that looks to me till this October, 10 months, Jan, Feb, March, April, May, June, July, August, September, October, 10 months. So in the year of disposal, that's going to be for 10 odd months. So 2,000 multiplied by 10 divided by 12, that's going to be 1667. That's pro rata. Exact number of months to be used in the year the asset was being held for use, both in the year of acquisition and in the year of disposal. This needs to be respected. Whereas in contrast to that, the other policy is easy to handle, but not so common these days, because this policy does not require us to get into those sort of months. Rather, full in the year of acquisition and none in the year of disposal, which means this full in the year of acquisition, none in the year of disposal. Full none policy. Full none policy. Okay with that. full in the year of acquisition, none in the year of disposal. So this policy does not require us to think a lot because we don't have months to count and all. This is where we will have to be so much precise about how many months in the acquisition year, and there we can make a problem. Instead of writing 8 months, you may end up writing 9 months, 7 months. You have to be so much watchful about so that you won't make a blunder into it. So that had to be revised. I have been able to. Policy. There's nothing on this page that's been written and not been talked about. But that still does not end the whole debate of the depreciation. We still have to get into some more stuff. But what the way things are written back into a lecture notes with regards to depreciation, you can have a look, starting off with the definition of this, which I have been telling you not to cram it. You only have to have the essence of it, which I already have given to all of you, matching concept. The accounting for that, the methods of the depreciation, the two key of them are straight line reducing, how the way the things they go under this method, how the way the things they go under this method. Commencement is from the day when an asset becomes available for use, even if it has actually not been used. Available for use. Even if it has not been used yet, still the depreciation will start happening. Complex asset. Don't be worried. Just the name is complex. Topic is not complex. What is complex asset? A complex asset is a big asset. A huge asset that will have various components. With each component has its own useful life. Aircraft is a huge A380, 777 Boeing. How huge is it? And they will have lots of components within, and each component they have got its own useful life. There are plenty of components, but if you take some broader components in front, like the engine of the aircraft, the body of the aircraft, the exterior, and the interior cabins, each they have their own useful life. The engine has got the shortest life because engine is the main thing on the basis of which it flies in the air. So they tend to have a very short life, probably 3 years maximum. After that, they have to come and replace it. But the interior cabins can have a longer life because they are interior and they are not exposed to as they're not exposed to any sort of deterioration in comparison to the exterior, because exterior is a body which has a body, and body has to face the whole tough outside weather conditions, air pressure. You can understand the life of the body will be less than to the life of interior cabins. And the life of the engine is the shortest of all. So how to depreciate an asset of that kind? Separately. I will have to depreciate engine separately based on to its own life. Interior separately based on to its own life. Exterior separately based on to its own life. And in the end, we will combine the totals. So first, that you should know what is complex asset. A huge asset comprised of having various components, with each component has its own life. Secondly, how to depreciate? The answer is separately, each component. That's been written over. Complex asset made up of various components, each with its different useful life. Each component is treated separately for the purpose of depreciation. The illustration on the next page illustrates this whole in a very nice manner. K operates in a leisure industry and has bought a boat, a ship, on 1st of May 2004. The boat was being classified as complex asset. Why? because of these reasons. The boat has got 4 parts attached to it: structure, propeller, fittings, and navigation system. Noticeably, each part has its own useful life. So we're not talking about 4 assets. We're talking about one boat, 4 parts, and each part has its own life: structure, propeller, fittings, and the navigation system. And how are they depreciating? Any example of this kind you will see, you will immediately say, oh yeah, this is complex asset. And I know how to depreciate. I will just go to depreciate structure by taking its useful life and cost as they did for propeller. And in the end, they've been able to add up the totals. This is the total depreciation that on the boat this year that they will charge. And the cost minus carrying amount equals to the net book value of this boat at the end of this year. So, like I said, the topic was just been titled as complex, but it's not really complex. It's just that. So little on the way, you're learning this complex asset thing. Never before in the life you have learned. First time by taking the course of FR, being the part of this topic, you people now have understood this little newish idea of complex asset. Okay with that? There's nothing being written extra to what you just have seen over here and here. And next talk is about changes into the depreciation estimates. The depreciation is based on estimates. First thing, the method that you have chosen, straight line method, reducing balance method, you have chosen by making an assumption that, yeah, this asset I feel provides me the same benefits, so I should have to depreciate the same all of its life. And then the assumption was that this provides me more benefit in earlier years, so I should have to depreciate more in year and then reduction. So that was your assumption. So you have chosen this method for this asset, for this asset, for this one. Secondly, the useful life was expectation. Remember, expected life. The life that you expect to have the use of asset is called as useful life. Thirdly, the scrap value was also my expectation. I expect I would be getting this much at the end of its life when I will throw it away. So depreciation, in short, based on estimates and assumptions. And IAS 16 requires the businesses to review those estimates every year end. They have to. They must have to. And if those are changed, they must have to start recording the depreciation based on the revised estimates. Means they must have to come and recalculate their depreciation charges on the basis of revised estimates. An effect of that will be prospective, means they will not go to change the depreciation charges of all the past years. Now and onwards, that this year's charge and for all the next years, they have to bring in the new estimates to calculate the charge based on to it. That is called as prospective effect. Current year and future years. And it also has a reason. Because today the estimates have been revised according to the situation of today. When the last time you have recorded the charge, that charge was according to the estimates of that time. Not that in all the previous years you have done some wrong depreciation. That depreciation which you have reflected in the past years were good according to the situation of that time. But if those estimates today have changed, so as from today and onwards, this should make an effect. This is called as prospective effect, not retrospective. And also, when you will come to apply new estimates must have to apply to the book value of the asset of today, not to the historic cost. That is all written over here. IAS 16 requires that the residual value, the useful life, and then asset is to be reviewed each financial year end, together with the method that you have chosen. All three things you have to keep on checking. What is the scrap value right now? What I expect now? Did my expectation change from what I was expecting a year before? So every year end, if the residual value or the scrap value or a method of the depreciation no longer is appropriate, should be changed. The change in the estimate is to be applied to the carrying amount of an asset on the date of change prospectively. All of that talk, I was having it, it's there written, and simply you will be able to read. See, this way I'm completing all of your lecture notes, making it sure that on the screen, I bring them in front, I highlight them, I try and underline them, and convincing you all that we are finishing the questions from. And if there is a little bit of text written, I'm also coming to read it in front, so that you develop a confidence of that these lecture notes have been well looked upon. Later, I can just open them at any time and also can read it for myself. There's nothing being left aside. This is the question on the top of the next page, which I can work to really explain to all of you the computation of the depreciation when the change in the revision, when the revision of estimates being made. What is the old and the new depreciation charge? Now, Eddingham has owned an asset for 5 past years. The depreciating the cost of 40,000 on a straight line basis over the life of 20 years. The company has conducted a review and now believes the asset to have the remaining life of 12 years. Now they have started believing 12 years. Scrap value is also given. Initially, there was no scrap value they had. Now they have started expecting the scrap value also. See, after 5 years, they're standing today. This just Eddingham has owned an asset for 5 years. It means 5 years have gone by and they are standing it at the end of the 5th year of asset. And the total life is 20. So 20 minus 5 equals to 15 years. So original remaining life 15 years. And that's the reason why it's the change in the estimate, because now they believe that they will be using it only for the next 12 years, not 15. So that is what we call it as change in estimate. So I cannot continue to depreciate my asset by considering that 15-year remaining life. I will now start depreciating it based on to this revised 12-year life. Also, this scrap value, they never thought. Now they have started also. So let's just fulfill the requirement, old and new depreciation. It's just the question in relation to. So let's go to find the depreciation. The old one and the new one. Old one will be based upon historic cost. The historic cost is given as 40,000, I guess. Yeah, 40,000. The life is given as 20 years. So that is about 2,000. Well, the new depreciation will be based upon the newer estimates, but making it sure that we apply them to the carrying amount of the asset of the day the estimates have changed. So at least I can write the revised estimates, the scrap value, and then the remaining life. The only thing I need to find it out is the carrying amount of the asset of today. So what is this carrying amount? I have to see for how long the asset was held by this business in the past 5 years. So if the cost of the asset was 40,000, and if for each year they have been recording 2,000, and for 5 years, it will become 30,000. 30,000 minus 4,500 divided by 12, the figure turns out to be 2,125. Okay with that? Problem. So you must have to try and apply the change in those estimates on the carrying amount of an asset on the day the chase has been brought in. So to find the carrying amount, you just have to see the cost of an asset and then the chart that you have been recording it in all those 5 past years. This should be the value on the day. The depreciation is 2,125. The carrying amount is 30,000. Okay with that? So by all of those corners, I have been able to complete this topic of depreciation after discussing the complex asset now recently, changes into the depreciation estimates, the policies that these two methods are based upon, the two of those methods, the way the computations will be performed, the terminologies those are involved. Itself, the definition of the depreciation was the application of matching concept. Crystal clearly, I have been able to complete the model of the cost. By spending a lot of our time, it's all in front of you. The course is about to finish in about next 20 minutes, and we are still in the middle of this topic and nowhere to finish it. This topic, before even starting, I told you that also already, although it's a revision-based topic, but it's more time consuming. There are many standards we have planned to finish, which are new, but we probably can finish 2 of those standards in one given class also. So it's a mix of some standards, they are longer, but they are not tougher. Some they are smaller, but very tougher. Some they have a length, but they have more of a content from your past courses. Everything that's coming to your way, you have to welcome it, respect it. A little discussion on the way, let's complete ourselves with disposals. Disposal of asset in simple word means the sale of asset. So how one should have to record the disposal of asset? How to achieve that disposal, the accounting entries behind. Looking back onto this page, first of all, disposal means the sale of an asset. So when an asset is disposed, we come to work, the gain may be a loss onto a disposal. By simply comparing the proceeds of the disposal to its carrying amount. Proceeds of the disposal to its carrying amount. Carrying amount is the amount at which the asset in the books being stated at, carried at, and you compare it up with the proceeds to find the gain or the loss. So suppose if in the books the value of an asset is $400, suppose, and it's being sold out for $500, $100 more than to what it in the books being carried for, then the dollar gain 100 that we have made is because of the reason of that we've been able to sell this off at the value $100 more than to what in the books it was being carried at. And similarly, if in the books the asset is valued for 400,000 being sold out for $250, 150 is going to be the loss that we have made out of it, because this has been the value at which in the books the asset was carried at, but being sold out for 250, 150 less, which is going to be the loss on the disposal. Loss in, so we might have a gain, we might have a loss, will be recognized in profit and loss. Might have a gain, might have a loss, will go and recognize in profit and loss. But recording a disposal is a 3-step process, and this is what I am going to make you understand by making an example. So suppose this is the T account of cost. Next is the T account of accumulated depreciation. Next is a T account of cost, accumulated depreciation, and the disposal. So hypothetically, the cost account has 5,000 in, accumulated depreciation has 3,000 in, an asset which has been disposed. Listen to that carefully. An asset this has been disposed, which has been disposed, which has been disposed. The cost of that asset is 2,000. So I have to make sure that this asset, when physically not going to be the part of business anymore, means I will be able to throw it away. So I should also have to take this out of those figures, my accounts. So in the very first place, I will have to credit the cost account and debit the disposal. Now this will make sure, and this will make sure that the closing balance of the cost no longer has this in, since it's been taken out. It's been eliminated, written off. You see, the asset is physically thrown out. So I'll also have to take that out of my accounts even. That's the first thing I have been able to take out. The cost of disposed asset was 2,000 and it was therein, and I have been able to filter that out. So the cost now that I will get in the end will be without the cost of disposed asset. Same I have to do for its respective. So I suppose the respective depreciation of this disposed asset was 500. So I will be able to debit the accumulated depreciation account and credit the disposal account to eliminate it. This way, the closing balance of accumulated depreciation that I have found is without it. So from my accounts, both the cost and the respective charge been filtered out. And these figures are now without it. In the last, the proceeds that I have collected upon the disposal of that now will be matched up to see if we have made the gain out of that or the loss. So if you look into that watchfully, the carrying amount of this asset is 1,500. And suppose if that has been disposed for 2,500, bank account debit, disposal account credit, I will definitely be able to make a gain out of it. That should be about 1,000. This is a gain on disposal, which the profit and loss will take. So gain will fall onto the debit side of the T account. Loss will fall onto the credit side. Depends. Gain will fall onto a debit side of the T account, and loss, as you can see, this T account has taken a debit of 1,000, profit and loss correspondingly being credited. So the credit to a profit loss is a gain on disposal. You also can see 1,500 has been the value of an asset being disposed out for 2,500. So 1,000 is the gain that they have made out of it. So recording a disposal is a 3-step process. Gain or loss is just the balancing figure. This is the first step. This is the second one, and this is the third one. If you look into that watchfully, very watchfully, check this out. Disposal account debit, cost account credit. That is what I have done in the very first place. Credit the cost account, debit the disposal account. In the second step, you had seen me debiting the accumulated depreciation account, credit the disposal account. Check this out. I have been able to debit the accumulated depreciation account, the disposal account was credited. And the last step was to record the proceeds. With that, the bank account has to debit, disposal account has to credit. That is this. Ultimately, this balancing figure that I have got is in fact the figure of the gain or may be the loss. That is how the way this disposal of asset on the way one has to treat. And we are good with that even. You might end up getting a gain or maybe a loss. The profit and loss will take it. Good with that? No problem. Got it right. So let's take our focus towards the revaluation model. A little bit we can talk about this today, but yeah, there are a lot of discussion left in this topic, which will continue into the next course. But a little bit now, the time that's being left, about 5 minutes or so, we can try and see whatever the part we can finish it for the reevaluation. Okay. So reevaluation is simply a process by which the historic value is transformed into its fair value. It's a process by which the historic value of an asset is transformed into its fair value. A process of transforming historic value to its fair value or market value. It's called as valuation. It's a process by which historic value of an asset is transferred to market value or fair value. This is called as valuation, revaluation. Could have a gain on revaluation, could have a loss on valuation, depends. If in the books, my asset was being carried at 1,000, but the same asset in the market is being valued for 1,300. Yeah, if I was using the cost model, I would have been fine with this, but because I chose to apply revaluation model, so to bring that market value to my books, the revaluation process will be carried out. As a result of it, I will be able to revalue this upward to 1,300 by recording a gain of valuation of $3. This is called as revaluation surplus or revaluation gain. To bring this market value to my books, the process of valuation will be carried out, which will take my value of an asset up to 1,300 by recording the gain of 300, which is called as the revaluation gain or maybe the surplus. Similarly, if in the same asset in the books being carried for 1,000, but the market value of that is about 800. So to keep this market value into my books, we'll have to bring it down to achieve this 800. That write down effect, the bringing down effect is called as loss on valuation or deficit. So it can be at times upward, it can be downwards. The objective is that the market value of an asset needs to be reflected. No matter what value you're currently being carrying it at, you have to make sure to bring the market value of an asset into books. So to bring it, you might have to sometime value it upward or value it downwards. Upward valuation is called as gain on valuation. Surplus. Downward valuation is called as loss on valuation or deficit. This is what we will come to achieve in the two of those questions. This accounting part, I will go to look at it the next week. It's the time taking part, what to debit, what to credit and all. But the computation part of that seems to me an easier discussion, which will enable you to at least understand the way the process of the valuation is conducted. So when I am going to meet you up now into my next session, we will start the course of the next week by working a question on evaluation, which is this one. And there's going to be another one, this one, which will also be involving disposals, 2-in-1, valuation disposals both. And there's still a lot many things that this topic requires us to learn from. And I would say that, in fact, is going to be the whole new part of the standard that you never have done before, all in the next week's course. And only possible when you people will come up with the revision of that, of what I just have explained. You see, it's a hardship. We are all being a part of it. And if you want this hardship to be fruitful to you, a little effort is required. Suppose your course is for 3 hours and you have to spend 30 minutes further on that to complete that week's task, 30 minutes of yours revision. If you just take those 30 minutes out of these 3 hours, may not be as beneficial to you. When the 30 minutes of your revision, you will be able to plug it in. So where you are putting an effort to take a course of 3 hours, you should not mind 30 minutes of revision before coming into the next course. It's always going to be helpful. It's always, you will agree to it or not, you will realize the importance of that or not. But I know 3-hour course with this 30 minutes, if you are going to plug it in, that will complete the whole talk of that week. Because this way, as a student, when you come into the next course, you make a good connection to after 6 days. And you find that topic to be easily continued, especially when you leave the course in the middle of the one topic which we are supposed to start in the next week. Fine. I will keep on giving you these sorts of tools and tips, which if you will start listening to me from the start of the course, it will be so good for the health of your preparation. Such a fruitful course, such a course within which now you formally have been able to see the way that I conduct my courses, I make the use of those summaries, the board explanations, and the lecture notes, based on to which now you can see what the next 4 months you are also expecting to see. I hope I have been able to live up to your expectations, and you also have to be in return live up to my expectations of coming into the course by revising the whole course of today. Hardly will take 30 minutes, not more than. That concludes the course of today. I will see you the next course to continue the topic of I-16. Have a good weekend. Thank you very much.